So today we'll be talking about the most important concepts in trading, which is liquidity and institutional money, which is the real engine behind every market move. You might have heard this term before in your trading journey. Liquidity is actually a very highly misunderstood concept, and people think that it is just big money. Of course, it's big money, like the money that is that involves bank, hedge funds, trading floor, big firms. But at the same time, liquidity means the the place, the zone where there are like plenty of orders, you know, where most of the people are willing to buy and sell, and at the same time, where retail traders are actually forced to exit their position. Just imagine, like, when you're trading with such a huge size, you just cannot enter anywhere randomly. There has to be enough orders on the other side. And this is where the market psychology comes in play, because behind every major liquid zone or area, there are human emotions like fear, greed, hope, regret. All these clusters of human emotions are around those major zones. To give you a very simple example of where to spot liquidity is when you see your retail charts like on TradingView or or other platforms, you might have noticed that in every major candles there are like some wicks, which seems like a bit of manipulation. But that is the perfect example of liquidity, like institutional zone liquidity, because that is where like most of the retailers they places their stop losses, and institutions they need to target those areas because there are enough orders where they can fulfill their positions. So the market has nothing against you. It's just the algorithms are designed in a way they scan the market 24/7. They are designed in a way to find the zones that are most profitable to big players. And I mean, like, if you count retail traders, which include every one of us, who are trading individually, until and unless you have like a multi-million or billion-dollar account or something like that, that is a different thing. But apart from that, all of us are retail traders. And as I said, they scan the market continuously and to find the best spot for big people, and then they push the price towards the zone of high liquidity where their orders can be fulfilled easily. The problem with the new retail traders or most of the people is that they are too much focused on predicting the next move, or the direction of the market, and they do not understand the core concepts of liquidity. And most of the time when they enter the position and the market starts to reverse, and then they start to say like it's a manipulation, because most of the time they place their stop orders and stop losses in danger zones. If you want to become good at trading, you really need to start thinking like a market itself. You should be asking different questions, not like where the price is going, but where the liquidity is sitting. And once you start to see that, or you start to think in that way, everything start to make more sense. The fake breakouts, the stop runs, the reversals, it just makes more sense because now you are watching the market in terms of where the liquidity is high. And that is what changes your perspective in trading. What you see on the charts is the reflection of human psychology expressed through pricing And once you understand it, you just don't read the charts anymore, but you rather anticipate human nature moving in repeated patterns. And the moment you understand that, you stop reacting to the price change and you start to think like a market.